Just a year ago, Blackrock was relatively unknown to most people, but now it has become a household name. It has been revealed that Blackrock owns almost 10% of companies involved in the military-industrial complex, and its CEO, Larry Fink, has been seen mingling with world leaders and billionaires. Even more concerning is BlackRock's plan to profit from the Ukraine war. However, the focus of today's discussion is the housing market, which is currently experiencing significant problems. Behind the scenes, BlackRock and other institutional firms are pulling the strings, exacerbating the crisis. This orchestrated ploy is aimed at driving the average person out of homeownership and commodifying the places where we live. While these allegations are not new, they have been gaining traction over the last few years. The looming housing market crash is not just a regular market cycle. It is a scheme to benefit large corporations at the expense of the average person's ability to own a home. It is a troubling situation, and it seems there is little we can do about it. The issue of BlackRock's involvement in the U.S. real estate market has gained media attention and caused outrage among the public. In response, BlackRock denied buying individual houses in the United States. However, they later admitted to investing approximately $120 billion in the U.S. residential markets, which includes buying up multifamily properties, apartment complexes, and other residential real estate. Despite the legacy media taking BlackRock's denial at face value and telling the public that there is nothing to worry about, the article is vague, and BlackRock's fine print reveals their involvement in buying duplexes, triplexes, and apartments. These revelations have raised concerns about BlackRock's growing influence and the impact it has on the housing market. BlackRock's deception tactics are clear, as they claim not to buy individual houses in the U.S. while admitting to investing around $120 billion in U.S. residential markets. The publication mentions other residential real estate, which may include mobile homes and smaller categories of homes, but this does not excuse BlackRock's actions. They are pricing out individuals who are buying apartments or trailer homes, yet they try to downplay the issue by denying the purchase of individual houses. BlackRock can use plausible deniability if caught buying up numerous houses. This approach is similar to that of other institutional giants. Unfortunately, media organizations have been captured by those with malicious intentions, leaving individuals to imagine the true extent of control BlackRock holds over various types of media platforms. With new crises emerging every month, such as the housing crash and the war in Ukraine, it is essential to remain vigilant against those who seek to deceive and control. About a year ago, a home builder in Texas constructed a development consisting of 124 homes, which was intended to increase the housing supply, provide affordable housing to people, and alleviate the pressure on the housing market with the introduction of new housing. However, instead of individual families or people engaging in a bidding war for a specific property, institutions were the ones competing for the entire development. Eventually, Fundrise, a company worth $5 billion, bought all 124 homes before they even hit the market for regular people, making it nearly impossible for anyone else to purchase a home. This bidding war had significant impacts, including the home builder avoiding realtor fees and not having to wait for mortgage applications or deposits from individual families. This situation occurred at an opportune time for the home builder, and Fundrise's action effectively eliminated the possibility of anyone else purchasing a home. Fundrise ended up overpaying for the homes by $32 million, which is double what the homes would usually sell for if they went to individuals. Similarly, Blackstone is one of the largest property owners in the world, with almost $1 trillion in assets under management and over $300 billion in property. Their spin-off company, Invitation Homes, bought up 90% of homes in some Atlanta zip codes, and they currently own 12.5 thousand homes in that city alone. Blackstone is able to secure cheap financing with an average rate of 1.4%, while most individuals would have rates of 3% to 4%, allowing them to overpay up to $20,000 for every home they buy and outbid any regular person. The institutions have dominated the single-family home market for a decade, strategically timing their exit just before the market peaked. They focus on buying the most important homes, positioning themselves to profit when the housing market crashes. This crash is already happening, with the average home in Sacramento falling 17% over 7 months, San Jose prices dropping over 20% in the same period, and Miami and Las Vegas prices falling by 7% and 13%. While interest rate hikes make it challenging for normal people to afford a home, these institutions can weather the storm with their cheap financing, unlike average people who cannot compete. The crash will affect these institutions differently. but for the average person, it means fewer potential buyers, decreased buying pressure, and ultimately falling home prices. In the past, adjustable rate mortgages caused the housing crash that began in 2006 by increasing homeowners' monthly payments. However, today most homeowners have fixed-rate mortgages. Nevertheless, home prices are determined by current interest rates and active market participants, not those with stable mortgage rates. When interest rates go up, the affordability of homes decreases, making it difficult for ordinary people to purchase homes during a recession. Moreover, during a recession, ordinary people suffer from job losses and savings depletion, further decreasing their chances of purchasing homes at low prices. Meanwhile, institutions like Blackstone and its $125 billion real estate investment are minimally impacted by falling prices and recessions. Although Blackstone's investors have been trying to withdraw their investments as prices fall, the company has contractual protections that allow them to keep the investors' money. In recent months, Blackstone has faced high withdrawal requests for their fund, resulting in them denying investors their money back and asking them to wait for the market to recover. This is unlike any individual who would lose their homes if they couldn't pay their mortgages. However, Blackstone and other institutional players stand to benefit from the crash after 2 or 3 years of falling home prices. When the recession is at its worst, they'll buy everything up, including homes at foreclosure, open market, or from banks for pennies on the dollar. They'll make billions in 10 years when prices rise again. This raises the question of whether this was all planned by institutional buyers like Blackstone and Zillow, who bought homes with cheap debt and overbidding to force the market up in a frenzy. Collectively, these companies ceased purchasing homes almost simultaneously, leading to a rapid decline in demand and transforming the housing boom into a housing bust within a few months. Whether these colossal corporations timed the market peak perfectly or deliberately caused it is unclear, but the outcome suggests they will benefit while ordinary people will suffer. Notably, BlackRock, Blackstone, Fundrise, and hundreds of other hedge funds, banks, and institutions have been purchasing people's homes, with Blackstone alone having purchased tens of thousands of homes. Now, at the market's peak, they have all decided to withdraw simultaneously, which raises suspicions about the possibility of home manipulation for profit. While it is unsettling to consider that these corporations are more closely linked to our governments than ever before, it is crucial to be aware of the situation. Even if it is difficult to swallow, be sure to like and subscribe. And thanks for watching.